It wasn't a technical error, it wasn't a regulatory oversight, it wasn't even a standard risk management protocol, it was the deliberate severance of the paper price from the physical reality. The recent moves by major financial institutions to restrict retail access to silver are not isolated events, they are not random policy shifts. They are not bugs in the system, they are the system protecting itself. The pattern is unmistakable, the arithmetic is merciless. When a monetary order reaches its mathematical limit, the exits are always closed, the drawbridges are raised, the gates are barred, those who hold the paper claims are locked inside the burning theater. Those who hold the physical asset are left standing outside watching the flames. This has happened before, it happens in every cycle. It happens in every empire, it happens whenever the debt grows too large to be paid and the currency grows too weak to be trusted. We are watching a historical script play out in real time. The actors change, the technology changes, the specific regulations change. But the incentives do not change, the constraints do not change, the outcome does not change. To understand why you are being locked out of the silver market today, you must understand the mechanism of the lockout itself. You must understand the history of the squeeze. You must understand the timeline of the collapse. This is not a story about a bank. This is a story about the end of an era. It is a story about the destruction of money. It is a story about the return to reality. The warning signs are flashing red. The data is screaming. The trap is set. Most people will not see it until the jaws snap shut, but you can see it. You can see the structure, you can see the precedent, you can see the inevitable result of unsustainable mathematics. The timeline is compressing, the volatility is expanding, the window of opportunity is closing. History does not whisper, it shouts, and right now, it is screaming the same warning it screamed in Rome, in Weimar, in London. The paper is not the metal, the claim is not the asset, the promise is not the payment, the mechanism we are witnessing. Restriction of access to hard assets during a time of monetary stress is not new, it is the signature move of a dying currency regime. It is the reflex of a sovereign power realizing that it has promised more than it can deliver throughout history. When the gap between the volume of currency and the supply of real wealth becomes unbridgeable, the authorities have only two choices. They can allow the currency to collapse immediately, wiping out the savings of the creditor class and destroying the banking system overnight, or they can attempt to manage the decline by restricting the exits, forcing the population to hold the depreciating currency, and demonizing or outlawing the flight into hard assets. The incentive is always to choose the second path. The incentive is always to buy time. The incentive is always to pretend that the paper is still worth what it claims to be, even as the market screams otherwise. To see where this leads, we must look back at the original master of this deception. We must look at the empire that invented the mechanism of silver debasement and the subsequent lockdown of the economy. We must look at Rome. The Roman Empire stands as the ultimate case study in the slow, agonizing death of a silver standard. It provides a perfect mirror to our current situation because the Roman economy, like ours, was financialized, complex, and heavily dependent on the credibility of the state. At its peak under the Antonines, the Roman monetary system was the envy of the world. The silver denarius was the global reserve currency. It was accepted from the misty bogs of Britain to the scorching sands of Syria. A merchant could travel across 3 continents and pay with the same coin, knowing that it contained a specific guaranteed weight of pure silver. This trust facilitated trade, funded the legions, and built the roads, but the seeds of destruction were sown in the very success of the empire. The costs of maintaining such a vast hegemony were staggering. The legions required pay. The bureaucracy required salaries. The grain dole for the citizens of Rome required massive subsidies, and as the empire stopped expanding, the influx of plunder that had once balanced the books dried up. The turning point came under Emperor Nero in 64 AD. Nero ordered the mint to reduce the silver purity of the denarius from 100% to roughly 90%. He also slightly reduced the weight of the coin to the average citizen. The new coin looked the same, it felt the same, it had the face of the emperor on it, but in reality Nero had just created money out of thin air. He had stolen 10% of the wealth of every saver in the empire. and transferred it to the state. This was the first step on the road to ruin. It seemed like a genius move at the time. The immediate crisis was solved, the bills were paid, the legions were happy, but a signal had been sent to the market, the link between the currency and the metal had been broken. Over the next 2 centuries, emperor after emperor repeated the trick. The incentive was irresistible. Every time a war broke out, every time a plague hit, by the time of Marcus Aurelius, the silver content had dropped to 75%. Under Septimius Severus, it fell to 50%. The color of the coin began to change. It lost its bright silvery sheen and took on a dull coppery hue. The merchants, the bankers, and the soldiers noticed. They began to demand more denarii for the same goods. Prices began to rise, but the state did not stop. They could not stop. To stop would mean default. To stop would mean admitting that the empire was bankrupt, so they printed more. They mixed more base metal into the melt. By the mid-3rd century, under the reign of Gallienus, it had been replaced by the Antoninus. When the silver wash rubbed off, the social consequences were catastrophic. As the quality of the money degraded, soldiers refused the very currency they were paid to protect. Held in denarii. A lifetime of labor was reduced to a handful of copper slugs. The part that connects directly to the news about JPMorgan. As the inflation spiraled out of control, the Roman state did not admit fault. Instead, they attacked the merchants. They attacked anyone who tried to protect themselves by hoarding real assets. In 301 AD, Emperor Diocletian issued the edict on maximum prices. This was the ultimate attempt to lock the population into the failing system. It dictated the price of wheat, the price of beer, the wages of a stonecutter, the wages of a teacher. The penalty for violating the edict was death. The penalty for hoarding goods was death. The state was effectively saying, you must trade at our fake prices. You must accept our worthless coins. You cannot exit the system. The result was exactly what basic economics would predict. Goods disappeared from the markets. Farmers refused to bring their produce to the cities because the mandated price was lower than the cost of production. The economy locked up. Trade collapsed. The complex interconnected market of the Roman Empire disintegrated into a primitive system of local barter. The middle class, unable to preserve their wealth, fled the cities to the countryside, entering into feudal arrangements with powerful landlords just to survive. The monetary collapse had become a societal collapse. The flight to hard assets, land, gold, tools, was the only survival strategy. But the state made that flight illegal. The exits were closed. The silver was gone. Just like the Roman Empire, the Weimar Republic in Germany found itself trapped between impossible debts and a political inability to pay them. The scenario in 1914 was different in technological terms, but identical in structural terms. Germany had financed the First World War entirely through debt, expecting to win quickly and pay the bills with reparations from the defeated Allies. Instead, they lost. They were saddled with their own massive war debt plus the crushing reparations imposed by the Treaty of Versailles. The industrial heartland of the Ruhr was occupied, the tax base was shattered, the gold reserves were depleted. The government in Berlin faced a stark choice. They could raise taxes to punitive levels, which would likely cause a communist revolution. They could default on their debt, which would lead to a foreign invasion and the seizure of German assets, or they could print. They chose to print. The Reichsbank, under the direction of Rudolf Havenstein, began to monetize the debt on an industrial scale at first. The effects were subtle, a creeping inflation that felt like a boom. Employment was high, factories were humming. Foreigners flocked to Berlin to buy cheap German goods. The currency was being manufactured faster than the economy could produce goods. The ratio of money to stuff was exploding. The cracks were visible. By 1922, the dam broke. The confidence in the paper currency evaporated, and this is where the mechanism of the lockout appears again. As the inflation accelerated into hyperinflation, the German people desperately tried to exit the paper mark. They tried to buy anything tangible. They bought pianos they couldn't play, they bought machinery they couldn't use, they bought land, houses, and foreign currencies. But the most coveted assets were gold and silver. These were the only things that held their value absolutely. A gold coin that bought a suit of clothes in 1913 still bought a suit of clothes in 1923, while the paper price of that suit had risen to billions of marks. The government, seeing this flight from the currency, moved to block the exits. They imposed strict capital controls. They made it illegal to hold foreign currency. They restricted the ownership of precious metals. They demonized the speculators and hoarders who were allegedly driving up prices. The daily life of a German citizen during this period was a nightmare of volatility. Imagine a factory worker in Berlin. He gets paid at 1100 a.m. He throws his wages bundles of million-mark notes into a wheelbarrow and runs to the nearest bakery. If he arrives at 12:05, the money was melting in his hands. The velocity of money exploded. No one wanted to hold the paper for a second longer than necessary. The faster prices rose, the more the government printed to keep up. There is a famous story from this time that illustrates the total loss of value. A woman brought a wheelbarrow full of cash to the bank to deposit. She left the wheelbarrow outside for a moment to open the door. When she turned back, the cash was dumped on the sidewalk, and the wheelbarrow was stolen. The wood and metal of the wheelbarrow had value, the paper money did not. This is the ultimate destination of fiat currency. It returns to its intrinsic value, zero, but before it hits zero, the system fights back. The banks, the government, and the regulators do everything in their power to force you to hold the paper. They restrict withdrawals, they limit transfers, they manipulate the futures markets to suppress the price of gold and silver, making the paper currency look stronger than it is. In Weimar Germany, the middle class was liquidated. The pensioners, the savers, the people who had played by the rules and put their money in government bonds, they were wiped out. Their life savings couldn't buy a cup of coffee. Meanwhile, those who had borrowed heavily to buy hard assets, industrialists, farmers, speculators, became fabulously wealthy. The debt was inflated away. A mortgage that represented 20 years of labor could be paid off with the price of a single egg. This transfer of wealth was not accidental. It was the result of the monetary policy. And the restrictions on silver and gold were the walls built to keep the sheep in the pen while they were sheared. The government eventually stabilized the currency by introducing the Rentenmark backed by the land of Germany, but by then the damage was done. The society was radicalized. The trust in institutions was destroyed. The chaos of the inflation paved the way for the rise of extremism and eventually the rise of Hitler. The monetary collapse was the prelude to the political catastrophe. Just like the Weimar Republic, the British Empire in the 20th century faced a slow-motion crisis of solvency that led to a systematic restriction of wealth. The British example is perhaps the most relevant to us today because it happened in a sophisticated modern democracy. with a global reserve currency in 1914. The British pound sterling was the undisputed king of currencies. It was as good as gold. The Bank of England was the center of the financial universe, but 2 world wars and the loss of its colonies drained Britain's wealth. By 1945, Britain was arguably bankrupt. It owed massive debts to the United States. Its industry was bombed out or antiquated. Its balance of payments was in permanent deficit. The decline of the pound was a long, painful slide, punctuated by sharp devaluations and desperate government attempts to trap capital within the country. The government maintained strict exchange controls for decades. It was illegal for British citizens to take more than a small amount of currency out of the country if you wanted to go on vacation to France. You had your passport stamped with the amount of money you were allowed to bring. If you wanted to invest in American stocks, you had to pay $1 premium, a massive surcharge that effectively penalized you for trying to escape the pound. But the most telling restriction involved gold. For much of this period, British citizens were restricted from owning gold bullion. The government knew that if the population could freely trade their pounds for gold, the currency would collapse even faster, so they made the hard asset inaccessible. They forced the population to save in pounds and government bonds and assets that the government could inflate. Away, the most famous moment of deception came in November 1967. The British economy was struggling. Speculators were attacking the pound. The government of Prime Minister Harold Wilson decided to devalue the currency against the dollar, cutting its worth by 14% overnight. Wilson went on television to explain the move to the British people. In a smooth, reassuring voice, he uttered one of the most infamous lies in monetary history. He said, "It does not mean that the pound here in Britain, in your pocket or purse or in your bank, has been devalued." This was technically true in a nominal sense. A £1 note was still a £1 note, but in real terms,
it was a blatant falsehood. The purchasing power of that pound had just been slashed. Freezing Britain imported food, fuel, raw materials became more expensive. Instantly, the standard of living dropped. The savings of the British people were haircut by 14% in a single evening, and because of the capital controls, because of the restrictions on gold, they had nowhere to protect themselves. They were locked in the room while the air was sucked out. The 1970s in Britain. So the culmination of this process, inflation hit 25%. The country was dubbed the sick man of Europe. Labor unions went on strike demanding wages that kept up with the rising prices. The electricity was rationed. 3-day week garbage piled up in Leicester Square. The dead went unburied in Liverpool. It was a societal breakdown driven by the debasement of the currency, and through it all the average citizen was trapped. They could not easily buy gold, they could not easily move their money abroad. They were forced to sit and watch their wealth evaporate in the fires of inflation. The lockout was bureaucratic, legalistic, and polite, but it was just as effective as the death penalties of Diocletian. It transferred wealth from the savers to the state. It liquidated the middle class to keep the government afloat. The pattern repeats in 7 distinct stages. Stage 1 is the sound money era. In this stage, the currency is backed by a tangible asset, usually gold or silver. The government lives within its means. Budgets out of balance. Trade is based on mutual value. The economy grows organically, driven by savings, and the investment prices are stable or even slowly falling due to productivity gains. Trust in the system is absolute because the system is honest. The paper claim is merely a receipt for the physical metal. There is no more distinction between the two stages. To is the overreach, the society becomes successful, and the ambitious, the government commits to massive obligations. A great war, a vast welfare state, or an imperial expansion. The costs of these obligations exceed the tax revenue. The politicians are unwilling to raise taxes to cover the gap. Fearing unpopularity, they are equally unwilling to cut spending. The fiscal discipline of the sound money era begins to feel like a straitjacket. Stage 3 is the monetary shortcut. The government severs the link between the currency and the hard asset. They suspend convertibility temporarily. They debase the coinage. They print paper money to cover the deficit. This is sold to the public as a necessary emergency measure. The experts assure everyone that it is under control. The initial effect is often a false boom. Liquidity floods the system. Stocks rise. Real estate rises. The government can spend freely without taxation. It feels like magic. Stage 4 is the inflationary time. The excess currency begins to chase the finite supply of goods. Prices stabilize at first. The authorities blame specific factors, but wizard greedy corporations, supply chain bottlenecks, foreign speculators. They deny that the printing is the cause. They manipulate the consumer price index to hide the true extent of the damage. They assure the public that the inflation is transitory, but the savers begin to notice. The smart money begins to move. Stage 5 is the flight to hard assets. This is the pivotal moment. The population realizes that the currency is losing value permanently. They stop saving in paper and start spending it as fast as they can. They rush to buy things that cannot be printed. Land at commodities, gold, silver. The velocity of money spikes. The demand for physical precious metals explodes. The premium on physical coins over the paper spot price begins to widen. The paper market and the physical market begin to decouple. Stage 6 is the lockout.
The authorities, seeing the flight from the currency move to stop it, they cannot fix the money, so they fix the exits. They impose capital controls. They restrict the ownership of gold and silver. They raise margin requirements on commodities. They change the rules of the exchanges to favor the shorts and punish the longs. They create paper shortages to discourage physical delivery. This is the stage where JPMorgan locks retail out of silver. It is the desperate attempt to force the population back into the burning theater. Stage 7 is the reset. The system becomes untenable. The currency collapses completely or is redenominated. The debt is wiped out, either through default or through hyperinflation that renders it meaningless. A new monetary system is introduced, often pegged to a hard asset or a new reserve currency to restore trust. The wealth transfer is complete. The middle class has been stripped of its assets. The holders of hard assets emerge as the new elite. The cycle begins again, just like Rome, just like Weimar, just like Britain. We are now entering the dangerous later stages of this sequence. The mapping of these 7 stages onto our current economic reality is precise and alarming. We have passed through the sound money era long ago. We have lived through decades of overreach funding, global empires, and massive domestic entitlements. With debt, we have fully embraced the monetary shortcut, with quantitative easing becoming a permanent feature of the central bank policy. We are now deep in the inflationary turn. The transitory narrative has collapsed. The cost of living is soaring. The purchasing power of the dollar, the euro, the yen is plummeting, and now we are seeing the clear signs of the flight to hard assets and the subsequent lockout. The news that major banks are restricting retail access to silver is not a random anecdote. It is a textbook Stage 6 event. Why silver? Because silver is the people's money. It is the most accessible hard asset for the average investor. Gold is expensive. It is the reserve asset of central banks. Silver is industrial, strategic, and monetary. It is the Achilles heel of the paper money system, the paper silver market. The futures market is massive compared to the physical supply. There are hundreds of paper claims for every ounce of physical silver in the vaults. If even a small fraction of those paper holders demanded delivery, the market would break. The price would skyrocket. The illusion of the fiat currency's strength would be shattered. The banks know this. The regulators know this. The incentive is to prevent the squeeze at all costs by locking retail investors out, by raising margin requirements, by limiting the types of orders that can be placed. They are trying to reduce the demand for the physical metal. They are trying to keep the game going a little longer. They are trying to manage the decline, but the very fact that they are taking these measures is a signal. It is a signal that the physical supply is tight. It is a signal that the stress in the system is reaching a breaking point. It is a signal that the smart money is already positioning itself, and they want the retail public to stay away until the positions are set. There is a counter-argument, of course. The mainstream financial press will tell you that these restrictions are for your own protection. They will say that silver is a volatile, risky asset and that retail investors need to be shielded from the fluctuations. They will say that the banks are simply managing their own risk exposure. They will argue that there is no shortage of silver, only logistical bottlenecks. They will point to the spot price, which may be languishing or dropping, as proof that there is no crisis. But this argument fails when you look at the incentives, and the arithmetic banks do not restrict trading in assets that are plentiful and profitable. They restrict trading when they are on the wrong side of the trade. They restrict trading when the liability becomes systemic. If silver were truly abundant and the price discovery were honest, they would be happy to sell you as much as you wanted. The fact that they are turning away business suggests that the cost of fulfilling that business is higher than the potential profit. It suggests that they cannot source the metal at the price they are quoting. It suggests that the paper price is a fiction. Furthermore, the historical precedent is clear. Every time a government or a financial oligarchy claims to be restricting access for your safety during a monetary crisis, they are actually restricting access to save themselves. The risk is not that you will lose money on silver. The risk is that you will make money on silver and, in doing so, expose the insolvency of the counterparty under these constraints. The rational move for the bank is to change the rules. The endgames for this situation follow a fixed order. The first phase is controlled decline. This is where we are now. The authorities use tools like interest rate hikes, yield curve control, and market restrictions to try to let the air out of the bubble slowly. They want inflation to run hot enough to burn off the real value of the debt. but not so hot that it triggers a social explosion. They want to suppress the price of gold and silver to maintain confidence in the fiat currency. This phase can last for years, characterized by financial repression, negative real interest rates, where savers slowly bleed wealth to the state. If the controlled decline fails, if a geopolitical shock, a banking crisis, or a sudden loss of confidence accelerates the process, we enter the phase of chaotic collapse. This is the Weimar scenario. The bond market breaks. The currency goes into free fall, the supply chains seize up, the lockout becomes total, banks might close, ATMs might go dark, and capital controls become draconian. In this phase, the paper price of silver becomes irrelevant because you cannot buy it at that price. The physical price decouples completely, trading at multiples of the spot price on the black market. Finally, the system reaches the reset and restructure phase. The old currency is abandoned or repegged. A new system is launched, perhaps a central bank digital currency, CBDC, that offers total control and surveillance, or perhaps a return to some form of commodity backing to restore trust in this phase. The debts are written down and the wealth that was trapped in paper is gone. The wealth that was preserved in hard assets survives and becomes the foundation. For the new economy, the only variable is timing, and pain. The pattern is set, the mechanism is active. The gates are closing. This is not the time to be passive. This is not the time to trust the official narrative. This is the time for education. This is the time for resilience. This is the time to pay attention to the data, not the headlines. Subscribe to this channel to stay ahead of the curve. Prepare your mind, prepare your household, watch the exits, because when they fully close, they will not open again until the fire has burned itself out.